Hey guys, it's Shiv Haria here from Lifestyle Property People. I'm sitting in my garden and I wanted to talk to you today about the impact of increasing interest rates on the property market and what you need to be doing about it. So it's no secret that house prices have been increasing recently quite rapidly, and the current average house price stands at 286,000. However, all that might be about to change because of these increasing interest rates. So what are interest rates? Let's talk about that. Interest rate is basically the cost of borrowing money, and from a property perspective, the interest rate, the mortgage interest rate, will be the rate that you pay for borrowing the money on your mortgage. There is a slight difference between the Bank of England base rate and the mortgage interest rate that you pay, but what we need to understand is that they're both correlated. As mortgage interest rates increase, what obviously happens is that your cost of borrowing increases, and therefore your cash flow or your profit reduces. So that is what interest rates are in terms of how they affect property. Then we need to understand, but why are interest rates increasing in the first place? And to understand that, we need to look at the inflation rate. So what is inflation? Inflation is the general increase in the price of goods and services over time. The Bank of England has a target of 2% for inflation, but currently the inflation rate is 9.4%, so much higher than where it needs to be. And what the Bank of England is going to do is to increase interest rates to try and get it back down from 9.4 to the 2%, which is their target. But why does this work? Well, this works because increasing interest rates reduces the amount of disposable income that people have in their pocket, and so that reduces the spending that they do, and because they reduce spending, the demand for goods and services reduces, and therefore the price of goods and services reduces. But we just need to, one more thing to explain is understand, like, why did the prices in the first place increase? And the reason why the prices have increased is because we had COVID and the big pandemic. The government spent a lot of money to make sure that we didn't go into recession. So that was through lots of different varieties of government spending, including and not limited to, the loans and the grants and stuff that they gave out to people just to keep them going. So all that spending in the economy, without there actually being any more productivity in the economy, leads to a devaluation of the goods and services, and therefore an increase in the price of those goods and services. But what does this all mean for property investors? Now, this is pretty simple. An increase in the interest rates, we've said before, reduces your cash flow, reduces your profits, but that means that there's going to be a reduction in the number of people that want to hold property, because there's a reduction in the returns. So that reduces the demand for property itself, and as a result, that may reduce the price. Now, I think this is going to be more prevalent in London, where you're going to find the rents are going to be not keeping up with the mortgages. And in places like Leeds and Sheffield, where we invest, I think that there's enough of a buffer between the rents and the mortgages, and there's better returns. So people from London might say, well, let's sell up in London and let's go and buy in these northern cities where there is a better return and there is a bigger buffer there. One thing to realise is that there is going to be a time lag between when the interest rates, the base rates increase, and when these impacts take place. So the base rates in the UK increased at the beginning of this year, and we still haven't really seen the market starting to reduce. The demand is still very high, and I think that's because it's usually between a 12 to 18 month period, and we think that market is probably going to, the demand for properties is going to start reducing towards the end of this year, perhaps early next year, especially when the cost of living crisis with the energy bill starts to kick in. At the moment, energy bills are higher than they used to be. They'll go up again. The spend cap will go up again in October. But at the moment, we're having a bit of a, as you can see from my garden, a summer heat wave, and as a result, people aren't using a huge amount of energy. In the winter, when people start to use a lot more energy, that's when people will really understand exactly how much this is costing them, and that's when people will start to tighten their belts on their spending, I suspect. The only other thing to mention is that the prices of properties are not, and the way the market's going is not only affected by the interest rates, but it's also affected by consumer confidence and by the availability of credit in the market, the availability of mortgages in the market. At the moment, both of those two are very, very good, especially because people have a lot more money. They've saved a lot more money from the pandemic, not going on holidays, not having to commute to work, and just generally not spending. So there's a lot of money in the economy, and people need to put that somewhere, and property is probably going to be one of the main places they look to keep that over the next year or so as we do go into this recession. So what's actually going to happen? Here's what's going to happen that we think. Interest rates are going to increase steadily. They're currently at 1.75%. I think that in September they'll go to 2.25%. And then I think that they will increase to between 2.5% to 3% over the next year or so, by the end of next year. And that obviously is going to decrease the demand in London, as I've said, which is going to reduce the prices in London. It's also going to reduce the demand elsewhere, but I don't think that the prices elsewhere are going to reduce because there is more of a buffer. So I think elsewhere, like Leeds and Sheffield, there's probably going to be a bit more price stagnation rather than price reductions. And then after that, after the end of 2023, where do I think it's going to go? I think we can expect this 3% level for the base rate to remain going forward. So the reason that is because 3% is probably kind of like the norm, where we should be at the moment. Remember that interest rates previously have been at the 12 to 15% level, I think sometimes even 18%. Which I don't think we're going to see any of that in the near future, but I think certainly we have been very, very low for a long time. So it's not the case that 0% is or 0.5% is the norm, and we're now, going much higher. It's that 0.5% was and 0.1% was like absolutely ridiculously low interest rates, and now we're trying to sort of go back up to where they probably should be. And then I think once people realize that 3% is going to be the norm going forward, 2.5% is going to be the norm going forward for the base rate, then I think prices thereafter will continue to increase. So what should you do? This is the really most important bit of this entire talk. The first thing is you should fix your mortgages as soon as possible. If you have any buy-to-let mortgages, if you have your residential mortgage, you should fix it right now rather than being on a tracker, because mortgage rates are going to increase, and that's going to start to bite you soon. The second thing is that if you're looking to release equity from your own home, now's a perfect time to do it. If you wait, then interest rates will be higher, and so the cost of that borrowing will be higher. So the amount of return you'll need to make just to pay back that cost is going to be higher as well. As I said earlier, I think that 3% is probably going to be about the norm, so we do need to get used to that level of interest rate rather than the 0.whatever% we've been at for the last decade or so. And I think lastly, sort of just invest as soon as possible. Invest in property as soon as possible. Property is a stable asset. It's an inflation-proof asset because the price of property increases in line with inflation. But really, the interest rates are going to start kicking in, and they're going to start eating at your returns. So you've got to invest sooner rather than later, whilst the interest rates are still low, whilst the impacts of those increasing base rates haven't worked themselves through the market just yet. And ultimately, don't be scared of a recession. Realize that a recession is just an opportunity. It's just a change in the market. It's normal for there to be a period of boom and then a period of bust, and it's just a time for us to reset where everything is. So don't be scared of the recession. Make the most of the recession. I hope that's been a useful video for you, and look forward to seeing you all soon. Bye bye.